Good afternoon, everybody. So our GST study circle at Mumbai, Roha, Mahad, we are conducting this meeting from October 17. So every time when there are changes, when there is meeting of GST, we conduct meeting. Sometimes we get problem also during due dates. So, but I think we are continuing this meeting from October 17 till today. So today, our senior most GST partner and Advocate Mahesh and Pranav sir, who is the senior most partner of GST, will conduct a session. So, and Mahesh, Advocate Mahesh. So over to Mahesh and Pranav sir.
Thank you, Madhav Bagleji. It's been many years since this study circle is going on, and I'm happy that people keep on coming and in search of knowledge every time, and it's also good for us to understand the law, study it, and disseminate our knowledge. That I'll request the participants to keep themselves in mute mode. All the participants to keep themselves in mute mode. Well, I think coming to the topic right away, the agenda for today's meeting is the recent amendments which have been proposed in the Union Budget 2023 and the 49 GST Council meeting. Please. Fine. I think the amendments which have been proposed. Let's first understand that these are all proposals. The announcements in the budget have been made in the Act, but the effective date thereof are yet to be announced. So what we are discussing are the proposals, and the effective date thereof will come after the government's consents come. And as far as GST Act is concerned, whenever any amendment is there in the Act, the consent comes after all the states have given their consent to the amendments proposed in the budget. And generally that we have seen over the last few years that takes around 6 to 9 months for them to become effective. So whatever we are discussing today will become effective from a futuristic date, and that can range from 3 months to 6 months to 9 months. It can be any date. It depends on how the government or how quickly all the states respond to it. And now I think I'll straight away ask Advocate Mahesh Mandhana from our office to go through the various amendments which are proposed. We will not be touching upon all the amendments. We will taking up the important ones only, and Mahesh will take us through the entire amendments proposed. In case if anything needs to be added, I'll top up to that. And in case if there are any questions, everybody is requested to please type in your questions in the chat box, and we will be happy to reply to that to the best of our abilities. And possibly whatever questions are there, they should be in alignment with the proposed amendments that we are talking of. And secondly, if we may take up the questions if time permits during the session, or maybe at the end of the session we will take up the questions and answers. And with this, I'll now request Advocate Mahesh Mandhana from APMH to please start his discussion on the topic.
Yes, welcome all. Thanks Pranav sir, thanks Bagleji for nice introduction. Participants, now today we'll go through the journey of amendments made through Finance Bill 2023. As we know, it is still proposed. Finance Act is not yet passed. And number two, we will also go through the major recommendations made through 49 GST Council meeting. So first of all, we will go through the Finance Bill 2023 amendments only related to indirect taxes. Now I'm sharing my screen. So first of all, the section 1 to this Finance Bill 2003 clearly tells that all the amendments related to direct taxes, they will come into force from the date of enactment of Finance Act, section 2 to 122. Sorry, section 2 to 122, they will come into force with effect from 1st April 2023, and all other amendments, and especially in relation to the amendments of indirect taxes, they will come into force from the date of enactment of Finance Act, except certain amendments which I will cover at a later stage. Now, The first major amendment in direct taxes. First, we will cover amendment related to GST. Now, Section 10, as all of us know, this Section 10 of the CGST Act, it deals with composition scheme. Now, the change which is proposed is that till date, those registered persons who are carrying out their business through e-commerce operators, selling goods, supplying goods to e-commerce operators, they could not apply for composition scheme. There was a specific prohibition, specific restriction. Now, with this amendment is proposed that the registered persons who are supplying goods through e-commerce operator, they can also opt for composition scheme. But except this particular benefit, other restrictions like number one, the composition person, the person who opts for composition scheme cannot go for interstate supply. This restriction continues. Second, the registered person who is supplying services through e-commerce operator, he can still cannot apply for composition scheme. So sum and substance is that only the registered person who is supplying goods through e-commerce operator, he can only apply for composition scheme. Second important amendment is reversal of ITC in case of payment to suppliers beyond 180 days. This is a very old provision.
Mahesh,
yes, sir.
Regarding the previous slide, I would like to add one point.
Yeah.
Previous slide. We should note that if you can go to the previous slide simultaneously. Yeah. So one important impact of this amendment is that although the composition taxpayers have been allowed from a future date to make transactions through e-commerce operator, but there is an embargo in this. We should understand that they can make only intrastate supplies through the e-commerce operator and not an interstate supply through the e-commerce operator. And that is a big embargo which has been put on the composition scheme players. Generally, composition scheme taxpayers, they will be small businessmen, small shopkeepers who want to take advantage, of the digitalization and the e-commerce platform and sell their products across the country. And generally, whenever we buy products from an e-commerce operator, we never know where our product would be sold and who would be buying it. So there is a restriction, the restriction of not making any interstate supplies as is applicable today to all composition dealers. That amendment has not been done. So there is a restriction for making interstate supplies. Even if they are making through e-commerce operator, that restriction would still continue, and this should be borne in mind.
Yes, sir.
Next.
So the next is regarding reversal of ITC. As all of us know that if the payment to the supplier is not made within 180 days from the date of invoice, then whatever ITC is claimed on that particular invoice, that ITC needs to be reversed. So till the date, the procedure was that this ITC needs to be reversed by way of addition to the output tax liability. Even though it is a reversal of ITC, but it was specifically provided that it needs to be added to the output tax liability of the relevant return. Now, this particular ambiguity has been corrected through this proposed amendment, that whatever ITCs needs to be reversed, it will be reversed by way of other reversals or specific reversal clause which will be there in 3B, return 3B. And second one, regarding levy of interest. So ambiguity was whether interest would be leviable under section 50 subsection 1 or 50 subsection 3. The issue was that, as I already told, that whatever ITC was required to be reversed, it was required to be reversed by way of addition to output tax liability. In other words, it was treated as a short payment of tax, output tax. So the interest could have been levied by the department under section 50 subsection 1. But now, since it is clearly mentioned that it has to be reversed through ITC reversal only, ITC reversal clause, so the interest will be levied as per section 50 subsection 3, and as per section 50 subsection 3, whenever there is a reversal of ITC, the interest needs to be paid only if that ITC which is reversed, it was already utilized. if the ITC was not utilized, then no need of reversal, no need of payment of interest.
So this is a welcome amendment.
Yeah. Now the next is regarding ITC reversal in case of supply of warehouse goods. See, basically this particular amendment, it relates to section 17 as well as schedule 3. Just give you, in order to give you the background, in schedule 3 to the CGST Act, there are certain transactions which are not treated as supply at all, and out of them the relevant clauses here are clause 7 and clause 8 of schedule 3. This clause 7 and clause 8, they deals with the type of transaction number 1, that whenever the goods are supplied from one non-taxable territory to another non-taxable territory. It means when there is a supply of goods out to out basis, or it is generally called a drop shipment. So that it was first type of transaction, which was neither treated as a supply of goods nor treated as a supply of services. The second type of transaction was supply of warehouse goods before clearance for home consumption. In order to explain this particular type of activity, let us take an example that an importer has imported the goods, and instead of clearing the goods by filing the bill of entry for home consumption, that is by making payment of customs duty, he files inbound bill of entry. That is, he does not make the payment of customs duty. He, by filing inbound bill of entry, he clears those goods for warehouse. As all of us know, under Customs Act, there are two types of warehouses under section 57 and section 58. Public warehouses, these are licensed warehouses. Public warehouse and private warehouse. So if custom duty is not paid, bill of entry is not filed for home consumption, then you need to file inbound bill of entry and the goods are warehoused. Now, once the goods are warehoused, and if after warehousing the goods, but before filing bill of entry for home consumption, if the goods are again sold or again supplied to another person, then in that case also there is no levy of GST, because it is covered under schedule 3, neither treated as a supply of goods nor supply of services. Now third type of transaction is when the goods are supplied by the consignee by way of transfer of document title to the goods after the goods have left the port of origin, but before they are cleared for home consumption. This we generally called as treat as high seas sale. Even in the pre-GST era, the nature of activity was same, high seas sale. For example, if I would order certain goods, say from China, and the moment the goods leave the port of China and I receive the bill of lading, either electronically or physically, whatever, if I transfer that bill of lading or that document of title to another person before the goods reach, the Indian territory, or even if the goods reach Indian territory, but before they are cleared for home consumption, if I carry out supply of goods before they are cleared for home consumption, then all those transactions, they are related as high seas sale. So in other words, this supply of warehouse goods before home consumption, number 1. Number 2, high seas sales, as I told, by way of transfer of document title, they are one and same. The only difference is that once before the goods are warehoused for home consumption, I again repeat, before the goods are warehoused for home consumption, all those transactions are not covered in this amendment. They are treated as means under schedule 3 only, and this particular transaction, supply of warehouse goods before home consumption, it is also under schedule 3. The only change which is made is that whenever such type of supply will be made, then whatever ITC will be there, the relevant ITC, it will require to be reversed under section 17 subsection 3. That is, the same will be treated as an exempt supply only for the purpose of reversal of ITC, and the relevant ITC needs to be reversed. So this was the amendment relating to ITC. Previously, for all the transactions under schedule 3, there was no need of any reversal of ITC except that sale of building or sale of land. But now this one more transaction from schedule 3 category has been added to reversal of ITC category, that is supply of warehouse goods before they are cleared for home consumption. So this was the amendment. Pranav sir, any
So,
comments?
yeah. So I think well explained. So I think now, after this proposed amendment, please go on the previous slide, Mahesh.
Yeah.
Yeah. So, so the impact is that now, as Mahesh told, that there are in Schedule 3, there were three kinds of supply: out and out sales, inbound sales in the customs warehouse, inbound, export, and third was the high seas. So out of these three, only the inbound, export type of transactions, they will now be treated as exempt supplies for the purpose of ITC reversal, because otherwise these are neither a supply of goods nor a supply of services, and then hence no reversal should have happened of the direct input tax credit in relation to such supplies, or common input tax credit in relation to such supplies. So now what will happen, wherever there are any inbound or export warehouse transactions, so high seas is still not affected. So for high seas transactions, no ITC reversal is required, either direct or indirect. So if there are, say, certain expenses which are incurred towards such expenses, say for inbound warehouse transactions, there are certain charges which are levied by the, say, the customs house agent or by any other person, or any professional services are received, or any handling charges are being paid for that, for such inbound and export warehousing transactions. Those are transactions which are directly in relation to such supplies, which will be treated as exempt supplies for ITC reversal. So in such cases, ITC reversal will happen on that entire amount. Apart from that, the normal common expenses where ITC is there, say audit fees, professional fees, telephone fees, mobile fees, etc. So those are the common ITC. That common ITC will also have to be proportionately reversed qua the inbound and export warehouse sales. So that is the impact of this amendment. Yes,
Yeah.
Mahesh. And Mahesh, you please keep on the slide simultaneously while you are talking,
Okay, sir.
and not the header only. Okay. Yeah.
Okay. Just one more addition. Actually, if for the purpose of section 17(3), this reversal of ITC provision, if we see the definition of exempt supply, the exempt supply includes this nil rated supply, number one. Number two, section 11 supply, exempted supply, and number three, non-taxable supply. So this non-taxable supply includes those supplies on which tax is not leviable. That is your alcoholic liquor for human consumption, then this petroleum products, and also this Schedule 3. But till the date, they have not treated the transaction under Schedule 3 except the one I have told. But now they have added another transaction to Schedule 3. So they are well within their powers. So now we need to comply with this. Now the next one is denial of input tax credit on expenses in relation to CSR. Now this was a litigative point, contentious issue going on since a long time. Since under Companies Act, these companies under section 135 Companies Act, if I'm not wrong, they are required to incur certain expenditure for as towards discharge of their corporate towards discharge the social responsibility. Generally, this quantum of the expenditure is certain percentage of the net profit, generally 2%. So whatever expenditure was incurred till the date by companies, by corporates towards CSR, the litigation was going on whether ITC will be available or not. The main contention of the department was, in order to disallow the expenditure, that these type of expenditures or the whatever inputs or input services are acquired through this expenditure, they are not used for the purpose of business. So one of the main conditions of section 16 is not satisfied, so this will not be allowed. And from the taxpayer side, they were contesting that yes, this is this expenditure incurred under statutory obligation, so it should be allowed. So finally, by way of this proposed amendment, they are putting an end to this litigation, and now all the expenditure which is incurred for CSR, it will not be eligible for ITC. The impact will be that for example, let us say previously they have incurred say rupees 1,000 towards CSR expenditure, and on that 180 rupees ITC has been paid. Now, if by law they are required to incur 1,180 rupees, just an example. So just by incurring 1,000 rupees expenditure and paying tax of 180 rupees, their obligation will be completed. So as far as companies are concerned, there is no loss for them. But definitely, if we think from public objective or the objective of the government behind introduction of the expenditure, definitely there is a setback to this object. Yes, sir.
Yeah, so I think there were various advanced authority rulings on this subject, and many of them were in favor of the taxpayer that ITC should be allowed in relation to expenses incurred for CSR activities. Say, for example, some project a company has undertaken to make public toilets in a village. That is a CSR activity, and there is expenditure incurred towards that, and so much cement, etc. All that is there, and there was GST being paid on that, and CSR activity is mandated under the company law itself, and hence the advanced rulings had taken a stand that ITC in relation to such CSR expenditure should be allowed because it is neither a gift, it is not a gift also, it is a expenditure, so it is not qualifying under 17(5)(h) truly in that sense. So it is an expenditure which is incurred for a social responsibility by the company, which is envisaged by the government and by the law. So that was the situation. But now I think the government has taken the stand. Of course, there were some adverse advance ruling also which were against the SSC. Yeah, under the service tax law, there were one or two favorable judgments on CSR, and that service tax should be eligible. Service tax input tax credit on CSR expenditure should be eligible. So that was the scenario. So now the only point is that this will be effective. This amendment will be effective from say 1st of October 2000. Say this amendment will be effective from 1st of October 2023 after coming into effect. Then whatever expenses are incurred till date, whether they will become eligible or not, say in case even if there's a negative AR in some state, can that officer take that stand of that AR and deny this? According to me, now we have a strong ground to tell that CSR expenditure has become ineligible from a future date, say maybe from October 2023, say for example, and hence any expenditure incurred prior to that should become allowable. That is our opinion, and I feel it has a strong footing also. So whatever expenses are pending for the companies for their CSR, and if they feel they want to take the credit, it is eligible. Of course, as Mahesh already stated, the GST impact, either it's an expense or it's the input tax credit. So whether to count out of that 1000 plus 180 rupees GST, whether to debit 1000 rupees to the CSR expenditure account or 1180 will always be the question. Otherwise, if this not taken into consideration, there is one more additional aspect which comes out of it. Say as per the obligation, see what they have mentioned, if the same is obligatory in pursuance of the provisions of the Companies Act, say as per the obligation of the Companies Act, the company was required to make a CSR expenditure of 1 crore rupees, basic, okay, but the company has made an expenditure of 1.5 crores. So what should become disallowable? I'm talking of the scenario after this amendment comes into effect. Will the company be disallowed only 1 crore and the balance 50 crore, 1.5 crore, so 0.5 crore, if it is incurring extra expenditure voluntarily, will it be hit by this provision? I don't think so. It will not be hit because where it is obligatory only, there only it will be hit. So 1 crore was obligatory for the company, 1 crore will be hit by the ITC reversal. The balance 50 lakh rupees, which is voluntary in nature, or say in case of some other companies where CSR is not applicable only in some cases. Okay, CSR may not be applicable, but they are doing CSR expenditure. Will they become eligible, or will they be allowed the ITs? I think it should be allowed because it is not obligatory for them and it is voluntary. It is in the course of business that they are doing it. Should not be issue, but I know the government is not easily going to allow it.
Yes.
Yes.
Now the next amendment related to persons not liable for GST registration. As per section 23, it deals with the cases where the registration is not required at all under GST law. Specified categories are two. Number one, those persons who are engaged exclusively in exempted goods or exempted services. Supply of exempted goods or exempted services, they are not at all required to obtain the registration. And number two are agriculturists. And the government has got right to issue to extend this particular exemption to other persons also by way of notification. So till the date, it was that section 23. The proposed amendment is that section 23 shall start with the clause notwithstanding anything to the contrary contained in 22 and 24. This is the proposed amendment. And Now the impact will be that the impact will be mainly in relation to section 24, because under section 24, as all of us know, there are certain categories of persons or suppliers who are required to obtain the registration mandatorily, even though their threshold limit of turnover has not exceeded. For example, let us take a person who is liable to make the payment of tax under RCM, persons who are supplying the goods or services through e-commerce operator other than certain specified supplies, in case of which e-commerce operator is required to pay the tax. Then beside that, persons who are undertaking interstate taxable supplies. So these are the persons who are required to obtain the registration irrespective of threshold limit. The impact of current amendment is that section 23 has been made independent. It will not be affected by the provisions of section 22 and 24. So the exact impact will be that if a person is exclusively engaged in exempt supply, or if he is an agriculturist, then irrespective of what is mentioned in 24, he will not be liable to obtain the registration. Simple example is person liable to pay the tax under RCM. Now, another important point, another caution is that even though the person who is liable to make the payment of tax under RCM, he is now not required to obtain the registration if he is not otherwise liable, but he continues to be liable to make the payment of tax under RCM. Now, for that purpose, a specific procedure may be introduced by the government. He may be given a temporary registration number or certain code through which he will make the payment. As far as tax payment is concerned, there is no change. The only change is with respect to registration and with respect to obligations that arise after registration. Now, the next one is time limit provided for delayed. This is a simple amendment for delayed filing of GST returns. Now, as we know, in case of GSTR1, if we do not file the GSTR1 up to a particular date, then we need to file it, maybe certain late fees or penalty. Same in case of section 39, 3B returns, we need to file it along with the late fees if there is a late filing. Section 44, we know annual return, that is GSTR9. If it is not filed within the due date, we need to make the payment of late fees and file it. Section 52, it deals with tax collection at source, that is GSTR8. GSTR8 returns. Now the proposed amendment tells that these returns, that is GSTR1, GSTR3B, GSTR9, GSTR8, all needs to be filed within 3 years. Within 3 years from the respective due date of filing of such return. So upper time limit has been provided. So it is actually, in one way, it is recipient friendly, or the person who is claiming the ITC, if we think from the perspective of that person, then definitely it is taxpayer friendly. And one restriction will be on the supplier. One type of control will be there on the supplier, that they needs to file the return within time. Otherwise, they will not be able to file it at all. If Pranav sir wants to make certain,
I'll like to add something to that. What is happening in many cases, the GST registration of many dealers are getting cancelled, and when we as taxpayers, or when the company as a taxpayer is taking input tax credit, the other persons, when we go to the website, it says that the GSTR registration has been cancelled with so and so effect, so and so date, because of non-filing of returns or whatever may be. And also due to pandemic, many persons were not able to file their returns regularly. So that was the case, and many such cases were cropping up. And in some cases, even the date for applying for cancellation, for revocation of cancellation of registration order, that date was also getting exceeded, and the appeals were not getting accepted. So even if a dealer wanted to come clean, pay the tax, file the returns, but his registration, since it was cancelled by the department, it was not getting operational once again, and they were not able to file the returns. Many such issues were coming. Apart from this, the normal time limit for filing a GSTR1, we all know that it is up to 30th November of the subsequent year, the current time limit, and after that the portal blocks it. So now when they are giving a time limit of 3 years, it is not that this time limit will be applicable for all the persons across the board. It will be applicable only in such special cases that the 3 years time limit will be applicable. That in case if a person is, his number is cancelled, he has gone for revocation, and then his number is getting restored, and because of that restoration, the portal, they are opening the portal for him to file the returns, because that is one requirement in many of the cases, that if a person's number has been cancelled for non-filing of returns, he will have to file the returns, and then the number gets restored, or he has to make the payment of taxes, show it to the officer. All those procedures are there. So in such cases, this 3 years limit will be applicable and not simpliciter. So we cannot say that now the other person or the regular taxpayer will get the 3 years time limit. It will be in such specific cases only where such limits will apply. So one embargo is that earlier, even if there was a delay beyond such 3 years, it was still being allowed. As of now, say even for 2018-19, if there is some certain cases pending, that was being allowed. And as per the new provision, that may not be allowed. I don't know whether the appeal period would get excluded from this, which generally should happen. In case if there is an appeal period, it should get excluded for counting this 3 years time limit. But no such mention has been made in the act, in the sections provision where this has come. So let's see how it happens, but it is not simpliciter that 3 years has now become applicable for filing of GSTR 1 or 9, or as for the matter GSTR 3B and 8. It is only in these specific circumstances where this will trigger. 3B, yes, 3B it is major. 3B it will help. And I think the intention of the government is to make everyone come into a compliance discipline zone. I think that is what is required for every taxpayer as far as the government is concerned. The government says it is a self-assessment. You need to ensure your compliances are done in time. You need to align yourself with the compliance discipline. And that is what the government is trying. And henceforth, even in such cases, the 3 years outer limit has been provided.
So the next one is a consequential provision, not so important. So I will just skip it because we need to cover a lot and we are running short of time now. The second, another important provision is clarification on interest on delayed refunds. So the nature of change is that previously, if the refund is not sanctioned or the refund is not disbursed, not sanctioned, disbursed, does not come into bank account within 60 days from the date of receipt of application, then the interest on delayed refund needs to be paid by the department. Now the proposed amendment is that the period for the period means the maximum period after which interest will be payable, it has been extended. Now it is in the favor of the department if you see it minutely. Interest shall be granted for the period of delay beyond 60 days from the date of receipt of such application till the date of refund of such tax to be computed in such manner. So as per provision, if we see section 54, then along with the rules, then refund needs to be granted within 60 days. After that, whatever delay will be there, delay beyond 60 days, then the interest needs to be paid for delayed refund. Now, penal provision applicable to electronic commerce operator. It's the provisions have become more stringent for electronic commerce operator. The important penal provisions that are introduced is that if any of the supplier who makes supply through e-commerce operator, and if is not complying with the obligation of the GST law related to registration, specifically I am going to deal with them, then the e-commerce operator will be penalized. Number one, if he allows a supplier through it by allows a supply through it by an unregistered person, means the person who is otherwise liable to obtain the registration, but he has not obtained. Two, if he fails to furnish the correct details in GSTR 8. And third, allows an interested supplies through it by a person who is not eligible to make such interested supply. As we have already discussed, sir has also emphasized on this. There's the composition taxpayers who can make only intra-state supply, not interstate supply. If they make any interested supply through e-commerce operator, the e-commerce operator will be penalized. Now, yes.
So Mahesh, so I think so. What has happened in this case is, so in case of a composition dealer, as we already discussed earlier, a composition dealer is not allowed to make interstate supplies, and now this makes our belief more stronger, because that interstate supplies subsection or the subclause was not amended. Simultaneously, when we come to section 122 penal provisions for electronic commerce operator, here we are seeing the a penal provision on the e-commerce operator that if he allows interstate supply for the composition dealer, that person will be penalized. So the government's intention is very clear. Earlier, there was a doubt that, oh, this does not appear to be the intention of the government. There seems to be an error in framing the law in the section 10 for the composition dealer. But that is not the case. The intention of the law becomes more fortified with this, that composition dealers will only be allowed in intrastate supplies and not interstate supplies. Now there will be two penalties. For the composition dealer, if he makes an interstate supplies through the e-commerce operator, his composition registration will be cancelled, or rather his eligibility for composition scheme will be cancelled, right? So that is so that will be an impact on that composition dealer, and simultaneously a penalty also on the e-commerce operator for allowing such composition dealers to sell. So government is ensuring from both sides that the composition dealers don't make a interstate supply. Similarly is the case for unregistered persons. One of the prime requirements of section 24, which we discussed earlier, section 23 is amended, right? So one of the prime requirements for section 23 is that if you are dealing through an e-commerce operator, you need to take registration. Now the penalty is also cast upon the e-commerce operator. If you allow such person, then you are also liable for penalty. Other person is also liable, you are also liable. So two-way penalty to ensure compliance of law again. Again, this is what the intention of the government is. Yes.
The next one is retrospective exemption. This is in the form of very taxpayer friendly amendment. The background for this amendment is that from 1st February 2019, by way of CGST Amendment Act 2018, this clause in Schedule 3, which I already discussed initially, in Schedule 3 of the CGST Act, activities are listed which are neither supply of goods nor supply of services. In that, Clause 7 and Clause 8 were introduced with effect from 1st February 19. Same high seas sales, out-to-out supply, that is drop shipment. Now, the ambiguity was that since these transactions were treated as were covered in Schedule 3 with effect from 1st February 19, so what will happen to the transactions that took place before that? So there was a continuous ambiguity and there was a fear in the mind of taxpayers that they may get taxed. Certain persons have made the tax payment, certain persons have not paid the tax on them. So now the government has clarified the position that that particular amendment in Schedule 3 will be applicable retrospectively from 1st July 17. However, this amendment has come with a pinch of salt. It is that if the persons, any persons have paid the tax on such transaction before 1st February 19, then that tax will not be refunded. In our view, this particular stand of the government may not stand in the judiciary, may not stand the test of law, because if any such taxes are paid before 1st February 19, then this type of payment of tax will be out of the authority of law. It will be against the constitution. Hence, the government needs to refund such taxes to the persons if they apply for that. Definitely, this particular refund claim by the taxpayer will be definitely subject to the important principle of unjust enrichment. I will not discuss in detail about that here. Okay. Now coming ahead, place of supply for freight on export of goods. Regarding this place of supply provisions, as all of us know, very important provisions under GST law, section 10 to section 13. Section 10 and 11 deals with place of supply of goods. 12, 13 deals with supply of services. So section 12 deals with where both the location, where both the supplier and the customer, I am just simplifying the terms, where both the supplier and the customer, they are in India only. So this 12.8, it particularly deals with the place of supply where the service is transportation of goods. Okay. Now the original position was that in case of transportation of goods, if both the supplier and customer are in India, then the place of supply will be the location. There is some issue in the error in PPT. I'm just correcting it. If the location of the if the recipient is registered, then the place of supply is location of the recipient. I again repeat, if the recipient is registered, the place of supply is location of the recipient. If the recipient is not registered, then the place of supply will be the place where the goods are given to the transporter for further transportation. This was the provision. And one important proviso was there. If the destination of goods is to a place outside India, then the place of supply will be outside India. This particular proviso now is proposed to be removed. So the impact will be that even though the destination of the goods is outside India, the place of supply will be determined based on the location of the recipient, number one, if he is registered, and if he is not registered, where the goods are handed over for transportation. This is the impact. Next. Yeah. Amendment in provisions related to OIDR services. Now, it is something technical. We need to understand it. First of all, this OIDR services, I think it's covered here. Yeah, OIDR services means online information data access and retrieval services. Basically, these services are services which are obtained through internet, number one. As per previous definition, they are obtained through internet, and in those services, in order to qualify as the OIDR services, in those supply of those services, there should be minimal human intervention, and they should be automated. So those services were treated as OIDR services. For example, I am downloading certain songs, certain important data, certain lectures from website, and those services will be OIDR. Now, second important definition or term will be non-taxable online recipient. So non-taxable online recipient, as per existing position, was governmental authorities or any individual or any other person not registered and receiving online OIDR services in relation to any purpose other than business. So in sum and substance, the definition of non-taxable online recipient means number one, government, and number two, any other person, that is individual, provided he does not use such services for the purpose of business, then he will be treated as a non-taxable online recipient. And the impact was that if a person who is outside taxable territory, if he is providing certain OIDR services to a non-taxable online recipient who is located in India, then that person who is sitting in non-taxable territory, he needs to discharge the tax liability by appointing certain person. There was certain procedure. In short, he was required to discharge the tax liability. Now, what is the amendment? There are two types of amendments. This definition of non-taxable online recipient has been now widened. Now, it simply tells any unregistered person receiving OIDR services located in the non-taxable territory. The important change is that previously, the important condition for non-taxable online recipient, the service should not be used for the purpose of business. If it is used for the purpose of business, then who is liable? Then the person who is receiving the services will be liable. But now, non-taxable online recipient definition is widened, and it tells that any unregistered person receiving service, if the recipient is unregistered, in simple word, then irrespective of the nature of use, the person sitting in non-taxable territory will be liable to pay the tax. Number one. Number two. Now, the impact is that number one, the condition of receipt of OIDR services, it's covered. Now, definition of OIDR services. As I already told, initially the condition was that the service should be essentially automated and it should involve minimal human intervention. Now, these particular conditions, both these conditions are removed. So the scope of OIDR services also widened. Now, even if the services are provided through intervention of human being, let us take the example of live lectures. If you are hearing certain live lectures from a person who is outside India, and if you are an unregistered person, then that person who is providing such services needs to pay the tax. And if you are a registered person, it goes without saying, then the registered person needs to pay the tax on account of import of services. So the government has tried to expand the scope of its treasury, the tax collection. Certain examples are given. Online course consisting of pre-recorded videos and downloadable PDFs. Before the amendment, they were OIDR. After the amendment, they continues to be OIDR because they are not involving any human intervention. They are almost automated. But the second type of example is there in front of the screen. Online courses consisting of pre-recorded videos and downloadable PDFs plus support from a live tutor. This plus support from a live tutor, due to this particular leg of this transaction, previously they were not OIDR because there was human intervention. Now they will be OIDR. Decriminalization of certain offences, it's quite technical. This amendment is with an
Mahesh?
intention to increase the ease of doing the business. Yes, sir.
The previous one, please. So, so basically, what I think the two amendments which have come in this OIDR, one, the definition of non-taxable online recipient has been, we can say, it is rearranged and drafted in such a manner that only two category of persons will not be considered as non-taxable online recipients, or rather, everybody will be except a person who is not registered, and except a government company who is liable to deduct TDS as per the provisions of the GST law. So those are the only two cases where the non-taxable online recipient, will be considered. It means the controversy regarding whether say a song is getting downloaded from a foreign website and it is downloaded say by a company, say APMH and Associates is downloading that song and paying the charges for that. So APMH was liable. But say if APMH was into business, but it was a person which was not liable to deduct, which was not having a GST registration or not taken a GST registration number, then in such cases, the OIDR company was having an ambiguity that whether the recipient, if he's registered or not registered, that categorization was not available in those cases, and whether they should pay the tax or they should not pay the tax. And in such OIDR companies who are generally outside India, they generally have a representative in India. And we have seen in so many cases, the companies in India are also not paying tax under reverse charge mechanism. And they are missing this on such categories because wherever Adobe is there, Google Drive is there, or any such other outside India website is there. And if they are not charging the GST of India, I know Google India, see, and the most common thing is say a Gmail data storage drive, right? It is say from normal allowed is 15 GB and the person wants to take 100 GB. Now, if that 100 GB drive is taken, then certain charges are charged by Google. Now, if that download is made by an individual, Google is liable to pay. If the download is made by a business entity, the business entity is liable to pay. But the business entity is paying only if it is registered. Otherwise, it is not paying. And that is where the entire controversy was coming at this. Some of these people were going out of the net. And to plug that, I think the entire definition has been revamped. But the government entities, which were earlier also non-taxable online recipient, they have still been covered as an unregistered person specifically, even though such government entities get registered for TDS purposes, GST TDS purposes, and that is what is sought to be covered in this in this definition. Coming to the other part of OIDR, which example which Mahesh showed us regarding the minimal human intervention. Now that there was the AR of Pearson, NCS Pearson, and there was a big bifurcation of detailed bifurcation was given for each types of transaction, wherein examination was conducted. There were 3 types of examination, and whether the company was liable to pay tax under reverse charge, or whether the other person was liable to take registration and take a OIDR registration and pay taxes. So that was the issue, and there this automation and a minimal human intervention point had come up, and now they have removed those words. But I think so. Since that word has been removed, so now even if there may or may not be a tutor. As of now, in the example, if you will go to the example, Mahesh. So in that example, in the next slide, in that example, in point number 2, as of now, what was happening that even if there is a live support from a tutor from outside India, OIDR was not getting triggered. But after this amendment, even if there is a live support, there is a human intervention, and whether minimal or maximum or whatsoever, once it is online information data access and retrieval service, it becomes liable for GST. If you are registered, you will have to pay under a reverse charge. Otherwise, that company will have to register here through its representative in that 99 series of GST registration number and pay the tax and collect it from the unregistered person. And that is what, that entire, both these amendments taken together uh, mean to us. Yeah, Mahesh.
This decriminalization of certain offences. These amendments are aimed towards ease of doing the business, increasing the ease of doing the business. Now, certain these type of offences which were previously criminalized, now they have been decriminalized. So this is quite technical. So
yeah, we can go ahead with this.
Yeah. For compounding of offences also, this minimum and maximum limit of compounding fee, they are now amended. Consent-based sharing of information, again, previously also the government was sharing the information, income tax, whatever we are providing the data under income tax, it was shared with GST service tax authorities. Now they have made it, they have got authority through this particular amendment that they can share the data, whatever data is provided on GST portal, they can share with other government agencies. Now, coming to the 14 GST Council Meeting recommendations. Actually, there are changes in customs and central sales tax also. Okay, now going with the flow of PPT, I will just first cover 14 GST Council Meeting recommendations. The one important recommendation in relation to this 14 GST Council Meeting is the long-awaited GST Appellate Tribunal. That report of group of ministers that has been accepted by the GST Council, and now we can just expect that within few months we may expect the constitution of GST Appellate Tribunal. Definitely, for the purpose of this, certain amendments will be further introduced in through this finance bill. Certain more clauses will be introduced in the finance bill, which is yet to be passed in the coming session, and through that the Appellate Tribunal may get constituted. Now, second one, I will just cover important amendments. These tobacco products, as far as these tobacco products are concerned, the government is proposing that this type of tobacco products, their export of those products should be allowed only through LUT, that is without payment of tax, and subsequent refund of unnoticed ITC will be allowed. And second change is compensation cess, which is leviable on such tobacco products, that is maybe pan masala, cigarettes and all. It is to be changed from ad valorem basis to specific tax base. That is, currently the compensation cess is levied on the basis of value. Now it will be made specific, might be per unit or per number, something like that, per packet. Now this small changes in two type of commodities. Rub, that is at present is 18%. Now the proposed is 5% if sold packaged, otherwise nil. And for pencil sharpener at present 18, proposed is 12%. Now revocation of cancellation is again another important welcome recommendation the GST Council Meeting, that presently whenever the registration is cancelled by the department due to various reasons, one of the important reasons is non-filing of returns. We have come across many such cases in the past, that if the return is not filed, say for a specified period, say 6 months, then the register, after issuing the show cause notice and all, they will cancel the registration. Now, if the registration got cancelled, there is an opportunity for the taxpayer to apply for revocation of cancellation, means to restore the registration. To restore the registration, the taxpayer needs to apply to the authority, and the authority may restore the registration after certain compliance of certain conditions. So this particular application for restoration of registration needs to be made within 30 days. Now that period of 30 days has been extended to 90 days. So directly 3 times. So it's a welcome recommendation by GST Council Meeting. And previously, beside this 30 days, there was another period of 30 days by extension for 30 days by the commissioner or by the rent authority, and for plus 30 days more. So minimum period, maximum period of 30 days mandatory, and extendable to further 60 days. This was existing provision. Now, the new provision proposed amendment is by default period will be 90 days, extendable to further 180 days, additional 180 days. So this is the provision. The second one is base judgment assessment order. As all of us know, under section 62, if the returns are not filed, either the return 3B return under section 39 or the final return under section 45, if they are not filed, then the officer can go for base judgment assessment after issuing a notice under section 46 for non-filing of return. And even if after issuing the notice, if the taxpayer does not file the return, he can go for base judgment assessment. There was a provision that if the base judgment assessment order is passed, and if within 30 days from the date of the order, the taxpayer files the return, then the assessment order gets cancelled automatically. This was the provision in VAT era also, MVAT era also. So same provision is here. So now for this period of 30 days has been extended to 60 days. So if after passing of base judgment assessment order, if the taxpayer files the return within 60 days, then also the assessment order will get cancelled, provided you need to make the payment of late fees, you need to make the payment of interest. It goes without saying. There's no relief in that. Another important welcome amendment proposed in recommendation in 49th Council Meeting. This for late filing of GSTR 9. As we know, at present the late fees is 200 rupees per day, 100 under CGST, 100 under SGST, and maximum 0.5% of the turnover in the state or in the union territory, whatever it is. So proposed is, now in the proposed amendment, relief is given, and relief is given slab wise. For those taxpayers who are having turnover up to 5 crores, the amended or the reduced late fees will be 50 per day, 25 under CGST, 25 under SGST, maximum 0.04% of the turnover. So from 0.5% to 0.04% big relief. And for taxpayers having turnover more than 5 crores but up to 20 crore, the late fees has been reduced to 50%, from 200 per day to 100 per day. But yes, maximum limit is 0.04%. So welcome recommendation, and no relief is there in the late fees, no change is there in the late fees as far as the taxpayers having turnover more than 20 crores is concerned. So since certain amendments related to customs are not there in the PPT, I will just cover them for the benefit of all. It is already 5:03, so within next 10 minutes I will cover those amendments relating to customs, important amendments. Number one, clause 123 of finance bill. It tells that as all of us know, under customs law, under section 25, various exemption notifications are issued. So under section 25, certain exemption notifications are without any condition, and certain exemption notifications are conditional notifications. All of us know a large number of notifications are issued under Customs Act. The most important is notification number 50/2017. It's a master notification. All of us know that. So as far as conditional exemption notifications are concerned, there was a sunset clause that those notifications will come to an end after the expiry of period of 2 years. No, on the 31st March after the expiry of period of 2 years. Let's take an example. If the notification is issued on 1st January 18, so on 31st March 20, the exemption will come to an end. This sunset clause has now been removed in case of certain exemption notifications, conditional. I will just give certain examples. Notification which are issued in order to comply with the international conventions or the obligations of India under World Trade Organizations. Then the notifications which are issued in compliance with foreign trade policies, in compliance with central government sponsored schemes. For those conditional notifications, now there will not be any sunset clause. They will come to an end only when relevant notification, specific notification issued by the government. Second one is in relation to the order to be issued by Settlement Commission. Those persons who have come across this type of cases, Settlement Commission cases, they might be knowing it, that previously there was no time limit for issuing the order by Settlement Commission. You can make an application to the Settlement Commission when the case is pending before an adjudicating authority. For example, show cause notice is issued and order is yet to be passed by the adjudicating authority. then you can go to settlement commission. If you know that a huge liability is going to come in terms of interest and penalty, you can go to settlement commission and you can pray before them for immunity from penalty and fines. So this is about settlement commission. So the change is that now the settlement commission needs to pass the order within a maximum period of 9 months, and it is extendable to further 3 months subject to sufficient reasons. Another amendment in Customs Act, clause 123, clause 124, and there are various changes in Customs Tariff Act. All of us know. So whatever changes are made in import duty in the first schedule to Customs Tariff Act, they came into force immediately on 2nd of February itself by way of provisional collection of taxes act, by way of a particular declaration by the government. This is old regime only. So the same provision got continued, and various other changes are made in the exemption notifications. All of them are already covered in the booklet which was circulated by us. And another important change in under Central Sales Tax Act. Under Central Sales Tax Act, previously the disputes relating to Section 6A, that is branch transfer, and Section 9 of Central Sales Tax Act, in case of those disputes, whenever those disputes are at the stage of or they are before the highest appellate authority of the state, technically, and in simple words, the sales tax tribunal, for example, in case of Maharashtra, if we want to make appeal after that, it needs to be made to another authority, that is Central Sales Tax Appellate Authority. Now that appellate authority is no more in existence. Now all such type of disputes are required to be made to the SESTAT, that is Central Excise, this Service Tax Appellate Tribunal, SESTAT, Customs, Excise and Service Tax Appellate Tribunal. So this was one important change in relation to legacy laws, that is Central Sales Tax. So with this, I come to the end of my presentation. Now the floor is open for questions, if any queries related to the points which are covered today. Yes, you can unmute yourself and you can raise the queries. I hope I am audible.
Yes, you are.
Yes, Mahesh.
So one query has already come in the chat box and answered by somebody, that who is required to file GSTR 9 for 2020. So there is no amendment in the budget provisions or in this GST Council meeting qua who is required to file GSTR 9. The law as was prevalent earlier, that has continued. So no change in any law as far as who has to file GSTR 9. Only change in law which has come is related to the late fees for filing of GSTR 9, where as told by Mahesh, so up to 5 crores turnover, it is restricted to 20 rupees per day, and above that 50 rupees per day it is restricted, and maximum ceiling is 0.04%. And as already mentioned by somebody, persons below 2 crore turnover, GSTR 9 is optional. Above 2 crore turnover, everybody has to file. Above 5 crore, 9C is also required to be filed.
Yes, any other query? One just important note I want to make, I already made it in the beginning, that amendment related to direct taxes will come into force from 1st April, and other amendments will come into force from the date of enactment of Finance Act, which all of us know it will come into force after giving the assent of the President. But amendment related to customs law, they came into effect immediately, and certain amendments in customs law, another clause 124 or 125, I think, they came into force on a specific date, which is mentioned in the finance bill. So about that, we need to be cautious.
Mesh, you would like to take up the queries?
Just a minute, sir. Has any extension in date specified for claiming GST ITC for 22-23 as compared earlier? No, there is no such extension. We already know that for 22-23, it will be November 23. Up to 30th November 23, we can claim the ITC by amendment in section 16.4. This is already made amendment. No further amendment.
Next, Mahesh.
Yeah. If you apply for cancellation of registration in August 20 and we received order in October 20, okay, has any extension in date specified
No,
See,
that is
you have-
always.
Yeah.
No. Mahesh, this you take up only what Sunita has mentioned, not LP 52. Both these queries are not linked. The subsequent answer is to the earlier one.
Oh,
So it is a simple question that if we apply for cancellation of registration in August 20 and if we received order in October 20, then what should be done? Till what time returns should be filed? What is the effective date of cancellation? Whether returns need to be filed till that date? That is the question.
see, if you have applied for cancellation and you have received the order, then you have to file the final return as per section 45. A final return. So for final return, there is no extension. Very clear. Final return needs to be filed under section 45. There is no extension for that. And has an extension in date specified for claiming GST ITC for 22-23 as compared earlier. Last date is 30th November. That's okay. Yes, for cancellation order, there is no extension for final return. I think I have given proper answer. Or the concerned person may just unmute and he can ask the question orally if I'm making certain mistake understanding.
Take the next one. If GST is paid on transfer of lease property, ITC is available.
Just a minute. Yeah. If I paid GST on transfer of lease property, ITC is available or not? See, in case of immovable property GST, that is one thing. So sections, we need to check whether section 17(5) is hit or not. So under section 17(5), in relation to immovable property, ITC is not available. Works on tax services in relation to immovable ITC is not available. So applying that analogy, lease property, if it is immovable property, definitely ITC will not be.
So is it to the extent of capitalization or otherwise also? That we should think.
See, if okay, see, actually capitalization, if the asset is capitalized, if that ITC is also capitalized, then ITC will not be available. If you are making regular payment of lease premiums and you are treating it as a revenue expenditure also, then also it won't be allowed.
महेश जी एक मिनट महेश जी हेलो महेश जी
बोलिए या
सर वो अपना 17(5) सेक्शन 5 में नहीं है, इमूवेबल प्रॉपर्टी नहीं है, वो हमारा मटेरियल है रॉ एफजी. So in this case, can customer avail ITC?
See, if you are not talking about immovable property, then definitely ITC will be allowed, provided all the conditions of section 16 are satisfied. Tax invoice is there, it is used for the purpose of business, and tax is paid into government treasury.
But it is cancellation. That invoice is RC is cancelled in the month of August. But material receipt is September.
Mahesh. I think there are two query mixed actually.
Yeah.
One is related to the transfer of lease property, that is a separate query, and second is the cancellation query. The order received in October 20, but the supply received by the customer in September 20, then he can get the ITC. That is the second query.
Okay.
Yes.
So we apply for cancellation of GST registration and we received order in October 20, and our BT
Branch transfer supply
received by customer in September 20. Then can he get ITC in September 20? So when was the order registration certificate cancelled? Which went from which date?
In August 20.
In August 20, certificate was cancelled. Which went from August 20. Okay.
But we received our order date is October 20.
No, order date is not important. From which date currently what authorities are doing, if the certificate is cancelled from a particular date, from a retrospective date, then they are not allowing the ITC to the recipient. Number one, this is the existing position contention taken by the department. But legally speaking, if the date on which the invoice was issued by you, if at the time of issue of invoice you are registered and all other conditions for taking ITC are satisfied, that is, you have paid the tax into government treasury and the recipient has made the payment to you, recipient is having tax invoice, he has filed his own return, then definitely he will be eligible to get the ITC.
Okay, sir. Thank you.
Okay. Any other query?
I think that query from Janvi regarding if GST paid on transfer of lease property ITC is available. She is mentioning that it is capital, so it is capitalized. It's right transfer from MIDC. Yeah, okay. So I think this MIDC is an issue. What is happening in case of MIDC is that one-time premium or lease premium, if it is charged by MIDC to the first buyer, to the first person, then there is no tax on that. But when the say company A had that plot in MIDC and that company A is selling that plot to company B, of course it's an assignment of lease rights which is given through the permission of MIDC to say company B by company A, and company A whether it has to charge GST. So first question is that whether company A should charge GST on that upfront amount which comes from company B in that MIDC for that MIDC plot. The answer is yes, it is chargeable.
Yes.
The second thing is that so company A will have to charge the tax, collect tax paid to the government. The second question is that whether company B, which is paying that lease premium to company A, whether it is eligible for set off. I think the judgments are not in favor of the dealer, although there is the judgment of Safari Retreat, which has now, traveled to Supreme Court. But still, I think that judgment has also it has given a generality that ITC should be available, but I don't think that will get accepted, or we have to see how it gets accepted, that judgment. But taking input tax credit of this capitalized amount is going to be a big issue. It's not going to be easy to claim that ITC of the lease premium, one-time lease premium which is paid, although it's a huge amount which is paid. But the way the judgments are coming, the way the government is targeting, I know MIDC association has made representation to the government. Several representations have already been made, but no relief as of now has come in any budget amendment or in the council meeting. So unless and until the government accedes to the requests of the MIDC association, there are so many such MIDC associations, like in Maharashtra, in all the states there are such associations. And unless and until a strong representation is further made for the specific point, till that time it's going to be very difficult to claim that ITC. Many cases are getting reopened now on such companies if they have claimed the ITC, and moreover in some cases the company who had sold, they have not paid the tax based on the interpretation of the law that they are not liable. So there also, in both the ways, things are happening. The company A in such cases who has sold its MIDC plot to someone else, although it's a sub assignment of MIDC rights technically speaking, but actually speaking it's a sale. But notices are being issued to both company A as well as company B, that is the seller as well as the buyer.
See, in relation to this lease of property, as in continuation of what Sir has told, if we see section 17 as already told, in case of section 17, this section 17 subsection 5 block credit, as far as immovable properties are concerned, number one, works contract services when supplied for construction immovable property not allowed to be, all of us know, and goods or services issued for construction of an immovable property. Both of these are credit, for both of these are not allowed, ITC. Now, with respect to this lease premium, if this lease premium is neither in relation to construction of immovable property nor in relation to construction of immovable property, either works contract service or goods or services acquired. So if this lease premium is capitalized, then definitely it will not be allowed as ITC because it is specifically mentioned in the law. But if lease premium is treated as a revenue expenditure, then the ITC will be allowed. Because see, as far as immovable properties are concerned, only the ITC related to construction of immovable property is disallowed, either in the form of works contract services when you acquire the property through works contractor, or when you construct the property directly on your own. Both of these ITC disallowed, but rent, lease premium, repair and maintenance to the immovable property, all these things, if they are treated as revenue expenditure, ITC will be allowed. And as sir has rightly told that in case of Safari retreat also, the matter is pending before Supreme Court. And even in the pre-GST era, for immovable property, this ITC was not allowed for construction of immovable property. Yes.
And the recent Supreme Court judgment of Builders Association of Navi Mumbai, of the CIDCO matter, which came very recently before few days only. There, the Supreme Court has at one point confirmed the levy on the transferor. So the levy has got confirmed.
Yes.
The input tax credit is still going to be a bone of contention as far as both are concerned. There could be a chance that ITC may become eligible because it is not for construction. That word for construction is very important over there. So that can be available. So what we are advising to our clients is that in case if you want to avail the credit, you may kindly avail it, because there's also a time limit to avail such credit.
Yes.
And it's a huge impact on the MIDC transactions. And I've seen crores of rupees of service tax is involved in this. The GST is involved on this lease premium amount. Crores of rupees. So, because recently we had a case where the tax component was more than 50 crore of that MIDC land. So you can imagine. So, if the ITC is required to be taken, the ITC may be availed. It may not be utilized till a clarity of law is received. So, in case, anyways, if you want to reverse it subsequently, you have a chance of reversing it later. I thank all the participants for attending this webinar. It was good to have an interaction with all of you. I hope most of your queries have got solved.